Okay, so now we're going to move on to part three, which is the macro outlook. So, yes, Jackson Hole Symposium, Powell speaking, there's other central bankers speaking as well. So just be mindful they're coming out. Just always remember what time all the important data and everything's coming out. But looking at the macro outlook, although inflation continues to slowly move in the right direction, and well, for most countries anyway, the closer it gets to that 2%, the harder it will be not only to get there, but to stay there as well. And of course, we've got to remember that this bout of inflation, it just, it was unusual. It was a very mix of conditions. Of course, we had COVID to start with. Those supply chains were cut, drastically reducing supply around the world. And then on top of that, we had governments and central banks adding trillions in stimulus, at all different levels, from households all the way up to companies, etc., etc. And then, of course, the public being released from lockdowns, they just needed that sort of retail therapy. They needed to go out and do some shopping. They just needed to be outside, really. But that increased demand, and that demand was going into quite a limited supply. Now, the fact inflation, was not caused purely by demand, it made it impossible for the central banks to regain control of inflation quickly. Yeah, and in fact, they still haven't. But they're still battling to get it back to that target 2% rate. They dreamed of getting 2% for decades, and then when it did come after COVID, it just launched itself, didn't it? So their solution has just been to consistently and aggressively, really, raise rates. And of course, many expecting central banks to potentially reverse those policies if there's chances of recession, if they increased. But again, as I've mentioned week on week almost, the central banks aren't frightened of a recession. They're more frightened of inflation. They can always boost an economy, they just can't drag it down to get rid of that inflation. And of course, finally, more people, more investors, more traders are now waking up to the fact that, these higher rates are here to stay. Uh, I mean, if you've been receiving our daily newsletter, you'll know that I've been warning of these higher for longer since last year even. And the fact that you shouldn't expect these rates to drop. If it is, it's going to be very slow, very incremental. And zero rates are for a crisis. They're not just to give us free credit or cheap credit. And that's something that you're going to have to live with now. This 4 or 5% levels are more realistic, I would say. And sort of as that reality hits investors and the fact that rates will stay higher for longer and they may even have to go a little bit higher yet, that's getting sort of priced in more now. We've seen stocks down again for the third consecutive week. That gold's under pressure. Part of that is of course due to the stronger dollar. And that's impacting commodities overall. But inflation will eventually drop to 2%. We know that. And although higher interest rates are impacting households and absorbing more of our disposable income, I think it's more a case that the demand is going to drop because the savings are gone. And of course, the fact is with those prices, when I go in the shops, I look at the prices. Well, depends what I'm buying, but when I look, it's just a surprise sometimes. When you compare it to what those prices were a year ago, it's really surprising how much some things have gone up. But you just don't realise it until you make those comparisons. So each country is fighting its own battle. You know, the US seem to be winning, and it's likely that they will get away with that soft landing. You know, more and more economists are expecting that now as well. Unfortunately, I'm not so sure that Europe will be so lucky to miss a recession. And to be honest, I think it could hinge on the weather. You know, as we go into autumn and winter. You know, the last one, that was really kind to us. It was such a mild winter. But the question is it going to be the same this year? Uh, when we look at the UK, which is where I'm based, as usual, you know, when inflation spikes in the UK, it just really struggles to come back down again. Everyone, you know, especially corporate greed, they profiteer from it terribly, and we just sort of suck it up and accept it. But that said, you know, it's still now over 3 times the target. It's at 6.8%. And it's going to be a challenge for the Bank of England, you know, especially with earnings, because they're increasing as well. So they're going to really struggle to get this inflation back to 2%. I think, you know, for the UK, it's certainly going to take longer than most. And you know, the potential for recession for me personally, I believe is much higher. Now, most commodities have been dropping. With the exception probably of oil, you know, that's still hovering around $80. Been going either side of that. As I just mentioned though, this corporate greed is still out there. And you know, now they've had a taste for these high profit margins, they're going to fight to hold on to them. You know, instead of when they see demand dropping that they drop their prices, they've actually gone the opposite way. When they see demand dropping, they've actually increased their prices to compensate. So high rates are in sort of tempting investors, I would say, into a little bit more risk off. You know, we've seen that with the stocks coming off for the last 3 weeks. And of course, bonds now are becoming more of a tempting investment. You know, when you look at the 10-year note last week, it went above 4.2%. You know, you're investing for 10 years, you're getting 42% return. Okay, you've got to wait 10 years for your money, but you know, you can invest in stocks, but will you get that same return? And is it guaranteed? Because, you know, that's the facts. You know, if you're investing in government bonds, so okay, they're not 100% safe, but they're probably 99.9. Depends which country you're going into, though, to buy them. Just remember that. Okay, so in this week, we've got this Jackson Hole Symposium. And again, that could start to give us a little bit more insight from the central bankers. You know, they're all going to start to meet up and discuss the global economy. And of course, there's plenty to consider. It's just not about inflation and interest rates at the moment. You know, there's the credit crunch that's potentially there. You know, banks having to tighten up their lending rules, etc., etc. Also, we've got China still fighting to boost their economy after lockdowns ended. You know, and really, I think that's been a surprise for most of us. But, you know, those major issues in China, sort of around their construction sector, even their finance, and you know, it's prompted them to cut rates. And you know, last week they were forced into the FX market to support their currency as well. Now, something to sort of think about. Hopefully it's not going to become an issue, but COVID seems to be making a comeback with the latest Eris variant. So, you know, that's starting to spread a little bit around the globe. Hopefully it's not going to be serious enough to bring back any controls. You know, what Boris came out with, living with COVID, is you know, it's just simply what we've got to do. And I don't think we could actually go through those lockdowns again. Whether the economies would survive would be another question, but whether we would personally survive would be a bigger question, I think. So it's going to be interesting to see how much of an impact this the BRICS nations. You know, they're having these meetings at the moment. They are focus much more on using their local currencies when they interact and do trade deals with each other. And there's also the potential for a common BRICS currency. Uh, they want to do that instead of the dollar. Now, it's possible over time that more and more countries may look to actually join that, because the US obviously use its currency to sanction nations and restrict the use of the dollar in certain areas. So, as I mentioned earlier about debt, so for me that's another area of concern, and obviously that was brought to the spotlight after the US was downgraded. And that government debt sort of globally is just frightening. And how are they going to? Okay, they can finance it, but obviously it's costing them a lot more to finance it now when they go into the market and issue bonds. They're having to pay much higher rates, of course. And of course, with these tighter banking restrictions coming, it's going to affect all levels, because that's going to make it more of a credit squeeze on sort of just the general public and smaller companies for sure. So just remember, it's still August. While it's still August, there's still a lot of traders on holiday, spending quality time with their family. Just continue to expect lighter volumes and higher volatility. Now, if you find you're getting stopped out more, then, either reduce the size of your trade. That's going to allow you to have a wider stop loss, but without increasing the potential loss. If that's not for you, or you're already doing that and it's still not working, then consider buying options. You can buy options to put on a long position, but you can buy options to put on a short position as well. So, but it does remove the need to micromanage the risk, because buying the option, you pay the premium, that's the most you can lose. So at least and you can carry them over evenings, weekends, whatever, because the most. It's like having a guaranteed stop loss. Now, if you don't understand them, or you'd like to get more into that or any aspect of trading, we hold lots of one-day workshops. There'll be some actually in this week coming up to help traders. Just contact us for details. We've got in our academy, we've got loads of different types of courses. We've got workshops, 1 week courses, and longer. And a couple of them actually include a free trading challenge as well. So what could be better than that? Okay, so that's about it for this part. In the next part, we're going to be moving on to my analysis. So again, here's, just reach out to us. We're happy to discuss anything with you around trading. If you've got any questions whatsoever, or any comments, anything you'd like us to see add to this, or, we like positive, and of course we accept negative comments as well. It all helps us to improve what we're doing.